Joining me now to discuss the latest is Congressman John Garamendi, who represents California's 8th District. Thank you for joining me this morning, Congressman. So I understand that you were briefed by the Treasury and the FDIC. Talk about those conversations and really the urgency in getting these backstops in place.
Well, the initial briefings we had beginning Saturday and into Sunday were essentially that the federal government, the Federal Reserve, the FDIC, and the Treasury were all working on a solution. At that time, we're looking at maybe someone buying the bank. Turned out that they were working on a much different solution. And I must tell you, I am so pleased with the president, not dithering, not taking a lot of time, but acting very aggressively to put in place a very solid financial backing for the bank at a time when the bank was actually investing in good, solid securities that were driven down as a result of the rapid rise in interest rates by the Federal Reserve.
But in terms of perhaps longer term, what sort of policies should be put in place to perhaps either improve stress tests or give a bit more clarity so that if we can, try and avoid a repeat of this happening?
Well, first of all, the Dodd-Frank legislation actually covered small and medium as well as the very large banks. In 2017-18, the Trump administration and the Republicans removed the medium and small banks from that same regulatory regime. And so they were left out there with some regulation, but not the same kind that the Dodd-Frank and the very large banks had to deal with. That may be part of the problem. But I think a much bigger piece of the problem was the fact that this particular bank appears to have most of its assets in government bonds, U.S. Treasury bonds. Those, unfortunately, for the bank, had a very low interest rate. As the interest rate was pushed up over and over and over again by the Federal Reserve, the value of those particular, that is the nominal immediate value, was significantly reduced. Now, if they were held to maturity, they'd be worth whatever the face value was. But that wasn't the case. As the run started, they had to sell those assets at a deep discount. The result was a failure of the bank. So there are several failures here that need to be taken into account. The regulatory regime had been removed. That may have made a difference if we had gone back, and we should revisit this and put back in place a regulatory regime for small and large banks, because contagion can start anywhere. And secondly, we need the Federal Reserve needs to be very, very much aware of what it is doing. Right now, the chairman is basically looking to eliminate 2 million jobs, that is, create unemployment to drive down inflation. Well, simultaneously, what he managed to do with that rapid increase in interest rates was to put banks in jeopardy.
But to that point, then, a lot of people online calling this a bailout. Is this essentially a bailout, if not of the banks, of some of these VCs who poured their money and perhaps didn't do their due diligence in terms of risk assessment when you do have such interest rate sensitive industries?
Well, first of all, there's two different pieces to this. One is the bank itself, its equity, its shareholders, and management. They stand to lose everything, as they should. That's the equity in the bank. And, this has gone into bankruptcy. Therefore, the shares are worth zero, maybe nothing. And of course, the management will lose their jobs, as they should. Now, that's where the jeopardy lies. That's where the risk is. With regard to the depositors, how are they to know on a day-to-day basis, even though they may be very large and may have a great deal of money invested in it, how are they to know the underlying financial status of that bank? Well, that's where the regulators come in. And apparently, given the very rapid increase in the interest rates and the similar rapid decline in the daily value, that is not the face value, but the nominal value of the U.S. government bonds, then we wind up with a bank that's in trouble. So what's happening here is the risk still remains to the shareholders of the bank and the management of the bank and the depositors, those that have relied upon the bank being sound. They're going to be held whole and not be held into account. And I think that's a good solution. Much needs to be understood here that the president didn't dilly-dally, just as he did with the American Rescue Plan. Within 45 days after becoming president in 2001, the president and the Democratic Congress put together the American Rescue Plan, which basically stabilized the American economy, kept many, many businesses in business, provided for their employees to remain employed. All of that was put in place very, very quickly by President Biden. And here we are once again when we have a banking crisis, the president and his administration stepping forward very aggressively to put in place a solution to stabilize the situation and allow us to work our way through this problem.
Because some of the language that we were hearing about the catastrophe of what this would mean to have so many tech sectors affected by this. And then when you think of some of the things that President Biden was asking for, management being fired, more oversight. But when you do have a bank that is so focused on tech, is there going to be some sort of oversight and perhaps some sort of diversification that's required so that you don't have a bank that is essentially a version of too big to fail by having such a dominant impact on the economy?
Well, first of all, this is a regional bank, and you would expect a regional bank to be banking in this region. And that's exactly what Silicon Valley Bank was doing. And most regional banks do that. Sometimes they step beyond their region, often to their significant risk because they don't know that region. But there are many, many different kinds of companies that were banking at Silicon Valley Bank, not just what you might call the high-tech companies. There were companies that were probably in the restaurant business and beyond. Well, we don't know all of that, but it is a regional bank, and it should be banking in its region. That's where they know their business. Now, the big multinational banks, their region's the world, and they've made plenty of mistakes as they try to analyze the world economy and the world and the various businesses that operate in that worldwide situation. So I wouldn't say that it's a problem for Silicon Valley Bank or any other bank in the Bay Area to pay attention to the Bay Area, the San Francisco Bay Area businesses of all kinds. And so let's go forward here. You got a bank in New York that has also been taken into receivership. And it was undoubtedly banking in the Manhattan business community, as it should.
Indeed. So we'll be keeping an eye on this. I do thank you for taking time with us on Yahoo Finance this morning. Congressman Garamendi, thank you so much.
Thank you. Have a good day.